particularly in the second quarter that we're in, the US, the Eurozone, the UK will see significant declines. Our economists are expecting double-digit GDP declines quarter on quarter sequentially. These are massive declines in the economy. Equally, there's massive amounts of fiscal and monetary firepower being thrown at this problem. So what you've got is a tug-of-war. You've got the economic slowdown caused by the shutdown, and that's going to lead to real pain in the economy. It's already started, particularly with small businesses in the U.S., with credit card losses likely to mount in coming quarters. Also, certain sectors of the economy will be under pressure, as you can imagine, things to do with aviation, oil and gas. But at the same time, there's so much money being thrown at it, particularly by the stronger governments. So I think it'll be an interesting tug-of-war. But the key message to remember is bank shares are going to be volatile, of course, but banks' balance sheets, banks' fundamentals are much stronger across the world, particularly in the developed world. Last time around, banks went into the downturn with very high leverage ratios. They were not prepared to cope. Also, bank management and particularly regulators, they've learned the lessons of the previous crisis, so they're using the playbook, and they're moving really, really fast.
You talked about, of course, the GCC and where you are in the UAE. I wonder how exposed the banking sector is there and what your prognosis is for how it emerges post-COVID-19, because not only do we have the extreme shutdowns in places like Dubai, but now we're also dealing with oil prices that are at the lowest level in about 18 years. So what is that going to mean for the GCC banking landscape?
Sure. Obviously, credit demand projects, large projects, large credit demand is going to be muted. There's going to be an increase in credit loss. I mentioned before, not just in the GCC, but globally, the SME sector is very fragile and vulnerable here. Equally, remember, the backdrop is that, like I said, with the global banks, the GCC banks have a lot of capital, and they have generally very high profit margins. So if you look at profit margins as measured by cost-income ratios or ROEs, the GCC banks or the UAE banks, the Saudi banks, have some of the best profit margins around in the world. That's a great shock absorber. And finally, you've got to remember is the sovereign balance sheet and currencies. These are dollar-linked economies, and that provides, if you're an emerging market investor, that provides some degree of comfort, because clearly, like in all crises, you've seen a big sell-off in certain weaker currencies, emerging market currency versus the dollar. You don't have that problem in the GCC, and there's quite a lot of investor interest, particularly in this area, because of that, because of this solid currency and relatively solid sovereign balance sheets here.
Hey everybody, it's Hadley Gamble from our new CNBC Middle East Bureau in Abu Dhabi. Thanks for stopping by. Now to watch more, you can try one of the videos that just popped up on your screen. And don't forget to subscribe.